If you've heard about the wheel strategy but never seen an entire cycle, let's use one real stock. SOFI. I traded it 4 different times. Every trade was published before the outcome was known. Let's replay the entire wheel. The wheel has only 2 steps. Sell a cash-secured put on a stock you're willing to own. If you're assigned, own the shares. Then sell covered calls until the shares are eventually sold. Then repeat. That's all the theory you need. Now let's see how it worked on SOFI. SOFI had pulled back into a major support area around $17. Implied volatility was elevated, and earnings were still outside the option cycle. The question wasn't, will SOFI go up? It was, would I be comfortable owning SOFI at $17? The answer was yes, so I sold the put. The expectation was simple. Either the option expired worthless, or I became a shareholder at a price I had already accepted before entering. The outcome: SOFI closed below the strike, and I was assigned. That wasn't the end of the trade. It was the beginning of the next phase. Now the objective changed because I already owned the shares. Price recovered back above the short-term moving average cluster. That gave me room to sell a covered call above my assignment basis. The expectation was simple. If SOFI stayed below the strike, I kept both the shares and the premium. If it closed above the strike, the shares would be sold for a profit. The outcome: the call expired worthless. Premium collected. Shares remained. Next step: sell another covered call. The chart hadn't changed enough to justify a different process. The shares were still owned, and price remained below my preferred exit. So I repeated the exact same framework. Another covered call above assignment basis. The expectation was to collect premium while waiting for either assignment or another cycle. The outcome: it expired worthless again. Another premium payment. The wheel kept turning. Price recovered again, and this time I could raise the strike. Notice what changed. Not the process. Only the chart. A stronger recovery allowed a higher exit level. That's why strike selection comes before premium. Premium follows the structure, not the other way around. This position is still active, so the story isn't finished yet. Cash secured put. Assignment. Covered call. Covered call. Covered call. 4 separate trades, 1 continuous wheel cycle. Every decision followed the same process. Only the market changed. Many people think the goal of the wheel is avoiding assignment. It isn't. Assignment is part of the strategy. Covered calls are part of the strategy. The mistake is judging every trade by its individual outcome. The wheel only makes sense when you look at the complete cycle. So what did this cycle actually produce? Over roughly 6 weeks, 1 cash-secured put and 3 covered calls generated $1,512 in option premium. If the current covered call is assigned, the shares will also be sold above the original $17 assignment basis. That brings the total cycle profit to approximately $4,512. On roughly $20,400 of deployed capital, that's about a 22% return, or roughly 190% annualized. Now compare that with simply buying SOFI shares over the same period. Buy and hold only participates in the stock's movement. The wheel participates in 2 return streams: the stock and the option premium generated along the way. That doesn't mean the wheel always beats buy and hold. Different markets favor different strategies. But this example shows exactly what the wheel is designed to do: generate returns from both ownership and premium while following a repeatable process. Looking at one trade tells you almost nothing. Looking at the entire cycle shows how the wheel actually works. Every trade you saw in this video was published before the outcome was known. Nothing was reconstructed afterward. If you want to follow the next wheel cycle in real time, you'll find every trade log, every weekly watch list, and the newsletter on Wizolver. No prediction, just process.